The headlines have already moved on, and what you're about to hear should terrify every California homeowner. Before we begin, I need you to do something critical right now. Hit that subscribe button immediately. This channel delivers the investigations that mainstream media refuses to cover. Like this video if you want to see more hard-hitting reporting. Drop a comment below with your story if you've been affected. And share this with every California homeowner you know, because what's happening right now could destroy everything they've worked their entire lives to build. Today, we're examining a crisis that has stripped 2.2 million Californians of basic insurance protection: State Farm, Allstate, Farmers, USAA. The biggest names in American insurance have walked away from California homeowners. Not next year, not gradually. This exodus happened in less than 24 months. Right now, hundreds of thousands of families are discovering they cannot renew their home insurance. Their mortgage companies are sending default notices, their property values are collapsing, and their only option is a state-run insurance program that costs 3 to 5 times what they used to pay, if they can get coverage at all. The official explanation points to wildfire risk and climate change, but the timeline reveals something far more calculated. This is a story of regulatory overreach, political decisions that ignored economic reality, and the systematic dismantling of a market that took 150 years to build. How did California reach a point where owning a home became financially impossible for millions of middle-class families? And what happens when the only insurance available costs more than the mortgage itself? Let's follow the decisions, the data, and the families watching their American dream burn to the ground. The first domino fell in March 2023. State Farm, California's largest home insurer with 1.2 million policies on the books, issued a statement that sent shockwaves through every real estate office in the state. The company announced it would no longer accept new applications for homeowners insurance anywhere in California, not just in fire-prone areas, not just in high-risk zones, everywhere. Families closing on new homes the following week found themselves scrambling for alternatives. Real estate transactions that had taken months to finalize collapsed in 48 hours because buyers couldn't secure the insurance required to close escrow. State Farm's announcement wasn't a warning shot, it was a declaration. After 100 years of continuous operation in California, the company was drawing a line. The risk had become unmanageable, the financial exposure was too severe, and the regulatory environment made it impossible to price policies in a way that covered actual risk. 6 months later, in September 2023, Allstate followed. California's second-largest insurer announced it would stop writing new policies statewide. Together, State Farm and Allstate represented more than 30% of California's entire homeowners insurance market. In the span of 6 months, nearly a third of the state's insurance capacity vanished. But the exodus didn't stop there. Farmers Insurance, which held another 7% of the market, began quietly non-renewing policies across Northern California. The company didn't issue a dramatic press release, it simply sent letters, tens of thousands of them. Homeowners opened their mail to find notices stating their coverage would not be renewed when their current policy expired. No explanation, no appeal process, just a 60-day countdown to find new coverage in a market that was already collapsing. USAA, AIG, Chubb, and Tokyo Marine followed the same pattern. By early 2024, at least 9 major insurance carriers had either stopped writing new policies or begun mass non-renewals. Industry analysts estimated that 2.2 million California homeowners had either lost their insurance or were facing non-renewal within 12 months. To understand the scale of this crisis, consider what 2.2 million policies represents. That's not just 2.2 million homes, it's 2.2 million families. Multiply that by an average household size of 2.8 people, and you're looking at more than 6 million Californians directly affected. That's nearly 16% of the state's entire population. The insurance industry had spoken, and the message was clear. California had become uninsurable. For decades, homeowners insurance operated on a simple principle. You paid your premium every year. In return, the insurance company agreed to rebuild your home if disaster struck. It was a contract built on trust, actuarial science, and the understanding that risk could be pooled and managed. That contract just got torn up, and what's replacing it is something that looks more like extortion than insurance. To understand how we got here, you need to understand Proposition 103. Passed by California voters in 1988, Prop 103 was sold as consumer protection. The promise was simple. Stop insurance companies from gouging customers with excessive rate increases. Give the state insurance commissioner authority to approve or deny any rate change before it takes effect. On paper, it sounded reasonable. In practice, it created a regulatory chokehold that would eventually strangle the entire market. Here's how it works. When an insurance company wants to raise rates in California, it must submit a detailed filing to the Department of Insurance. That filing includes actuarial data, risk models, claims projections, and justification for every percentage point of increase. The insurance commissioner then reviews the filing. Consumer advocacy groups are allowed to intervene and challenge the proposal. Public hearings are held. And months, sometimes years, pass before a decision is made. During that entire process, the insurance company must continue operating under the old rates. Even if wildfire risk has tripled, even if claims costs have doubled, even if the financial math no longer works. The company is stuck. And more often than not, the commissioner denies the full rate increase. Instead, they approve a fraction of what the company requested, forcing insurers to absorb the difference as losses. Between 2015 and 2022, California experienced 5 of the most destructive wildfire seasons in recorded history. The Camp Fire in 2018 killed 85 people and destroyed 18,000 structures. Insurance claims totaled $12 billion. The Tubbs Fire, the Thomas Fire, the Woolsey Fire, the Dixie Fire. Each one shattered records. Each one generated billions in claims. By 2022, insurance companies had paid out more than $50 billion in wildfire-related claims over a 7-year period. That figure is not speculative. It comes directly from the California Department of Insurance's own data. At the same time, climate scientists, fire behavior analysts, and risk modelers were issuing increasingly dire warnings. Wildfire risk was not decreasing, it was accelerating. Longer droughts, higher temperatures, more homes built in the wildland-urban interface. The conditions for catastrophic loss were worsening every single year. Insurance companies looked at the data and did what any rational business would do. They requested rate increases that reflected actual risk. State Farm asked for a 20% increase. Allstate requested 40%. Farmers submitted filings showing they needed to raise rates by 30% or more just to break even on policies in high-risk areas. And California Insurance Commissioner Ricardo Lara said no. In case after case, Commissioner Lara denied the full rate increases. He pointed to Prop 103's consumer protection mandate. He cited concerns about affordability. He framed the issue as insurance companies seeking excessive profits at the expense of working families. But the financial reality didn't care about political framing. Insurance companies were hemorrhaging money. State Farm reported $5.2 billion in underwriting losses in California between 2017 and 2022. Allstate posted similar figures. These were not small losses buried in corporate balance sheets. They were existential threats. By 2023, the math had become impossible to ignore. Insurance companies could no longer justify operating in California. The risk was too high, the claims were too expensive, and the regulatory environment prevented them from charging rates that covered actual costs. So they left. Not because they wanted to abandon a lucrative market, but because staying meant guaranteed financial ruin. This wasn't a market failure. It was a policy failure. And the people paying the price are the homeowners who did everything right, paid their premiums on time, and now find themselves completely unprotected. Sarah Martinez bought her home in Santa Rosa in 2015. It was a modest 3-bedroom house on a quiet street. Nothing fancy, just a place to raise her 2 kids and build a life. She paid her State Farm premium every year without fail, $1,400 annually. In exchange, she had $450,000 in dwelling coverage and $100,000 in liability protection. In March 2024, she received a letter. State Farm was not renewing her policy. No explanation, no appeal, just a notification that her coverage would end in 60 days. Sarah spent the next 8 weeks calling every insurance company she could find. Farmers told her they weren't accepting new policies in Sonoma County. Allstate said the same. Liberty Mutual quoted her $8,400 per year, 6 times what she had been paying. When she asked why, the agent explained that her home was now classified as high risk due to its proximity to wildfire zones. Her home hadn't moved. The risk had always been there. But the insurance industry had finally decided to price it accurately, and Sarah couldn't afford the result. With no alternatives, Sarah turned to the California Fair Plan. That's the state's insurer of last resort, created in 1968 to provide basic coverage for homeowners who can't find insurance in the private market. The Fair Plan quoted her $5,200 per year for dwelling coverage only. No liability protection, no coverage for personal property, no additional living expenses if her home burned down and she needed temporary housing. Just bare-bones structure coverage, and even that came with a waiting list. The Fair Plan was never designed to insure 2.2 million homes. It was meant to cover a few thousand high-risk properties at any given time. By mid-2024, the program was overwhelmed. Applications were backlogged for months, and homeowners like Sarah were left in limbo. Sarah's mortgage company sent her a notice in May. Because she no longer had adequate insurance, the bank was placing a force-place policy on her property and adding the cost to her monthly mortgage payment. The force-place premium was $9,600 per year. Her mortgage payment jumped by $800 per month overnight. She couldn't afford it. In July, she listed her home for sale. Across California, hundreds of thousands of families are facing the same impossible choice: stay and pay insurance premiums that exceed their mortgage payments, or sell and move somewhere more affordable. In Paradise, a town that was nearly wiped out by the Camp Fire in 2018, homeowners who rebuilt their properties are now discovering they can't insure them. The private market won't touch Paradise, and the Fair Plan's waiting list stretches for months. One resident, a retired teacher named Robert Chen, spent $380,000 rebuilding his home on the same lot where his previous house burned down. He followed every fire safety guideline. He used fire-resistant materials. He cleared defensible space. He did everything right. And now no insurance company will cover him. His only option is the Fair Plan at a cost of $12,000 per year. For a retiree on a fixed income, that's financially devastating. Robert is 68 years old. He doesn't have the option to start over somewhere else. So he's living in his rebuilt home, uninsured, hoping that another fire doesn't come. In Southern California, a different crisis is unfolding. Homeowners in Los Angeles, Orange County, and San Diego are receiving non-renewal notices, not because they live in fire zones, but because insurance companies are pulling out of California entirely. Maria Gonzalez owns a condo in Irvine. No wildfire risk, no flood risk. Her building is concrete and steel in the middle of a dense urban area, but her insurance company, Farmers, sent her a non-renewal notice in March 2024. When she called to ask why, the agent explained that Farmers was reducing its exposure across all of California. Her specific property wasn't the issue. The state itself was the problem. Maria found replacement coverage through a small regional carrier. The premium was $3,800 per year, more than double what she had been paying. She had no choice but to accept it. Without insurance, her mortgage would go into default, and her condo association required all owners to carry coverage. Walking away wasn't an option. These are not isolated stories. They are the new reality for millions of Californians. Families who did everything right are now being punished for decisions made by regulators and politicians who refuse to acknowledge basic economic reality. The insurance crisis is not just affecting homeowners. It's tearing through every sector of California's economy with devastating speed. Real estate transactions are collapsing. In counties designated as high fire risk, home sales have dropped by as much as 35% compared to the same period in 2022. The reason is simple. Buyers can't secure insurance at closing. Without insurance, they can't get a mortgage. Without a mortgage, they can't buy the home. Real estate agents across Northern California report the same experience. They list a property. Multiple offers come in. The highest bidder goes into escrow. And 2 weeks before closing, the deal falls apart because the buyer's lender required proof of insurance, and none was available. One real estate broker in Nevada City described it as a complete market freeze. Properties that used to sell in 30 days are now sitting for 6 months or longer. And when they do sell, it's often to cash buyers who are willing to take the risk of owning an uninsured home. That eliminates the vast majority of potential buyers and drives down property values. Home prices in high-risk fire zones have dropped by 15 to 25% since 2023. That might sound like an opportunity for bargain hunters, but it's a catastrophe for existing homeowners. Families who purchased homes at peak prices are now underwater. They owe more on their mortgages than their properties are worth. And they're trapped. If they try to sell, they'll take a massive loss. If they stay, they'll continue paying insurance premiums that rival their mortgage payments. And if another wildfire sweeps through and destroys their home, they may not have adequate coverage to rebuild. The ripple effects extend far beyond individual homeowners. Cities and counties across California depend heavily on property tax revenue to fund schools, fire departments, police services, and infrastructure. When property values drop, so does tax revenue. A 20% decline in assessed property values in a county like Butte or Shasta translates to tens of millions of dollars in lost annual revenue. That means layoffs, service cuts, and deferred maintenance on critical infrastructure. Fire departments, the very agencies responsible for protecting communities from wildfires, are facing budget shortfalls because the property tax base is eroding. It's a vicious cycle. Less revenue means fewer firefighters. Fewer firefighters mean slower response times. Slower response times mean more homes lost in fires. More homes lost means higher insurance claims and more non-renewals. And the cycle continues. Local governments are now facing a choice no elected official wants to make: raise property taxes on struggling homeowners to make up for lost revenue, or cut essential services and watch their communities decline. Meanwhile, a new industry has emerged to fill the void left by traditional insurers. Small, regional carriers with names most people have never heard of are entering the California market. They're offering coverage at rates that would have seemed absurd just 3 years ago. Premiums of $10,000 to $15,000 per year are now common for homes that used to cost $2,000 to insure. Deductibles have skyrocketed. Many policies now carry $50,000 or even $100,000 deductibles, effectively making them catastrophic coverage only. And the financial stability of these new carriers is questionable. Unlike State Farm or Allstate, which have balance sheets in the tens of billions, these smaller companies have limited reserves. If a major wildfire strikes and generates billions in claims, there's a real risk that some of these carriers will go insolvent, leaving policyholders with worthless paper. California's Department of Insurance is supposed to oversee these companies and ensure they maintain adequate reserves. But the department is overwhelmed. With so many new entrants flooding into the market, regulators don't have the resources to conduct thorough financial reviews. Homeowners are essentially gambling that their insurance company will still exist when disaster strikes. The mortgage industry is also adapting, and not in ways that help homeowners. Banks are tightening lending standards in high-risk areas. Some are refusing to issue new mortgages in counties with severe fire risk. Others are requiring larger down payments, 30% or more, to offset the risk of default if a home burns down. For first-time homebuyers, this effectively locks them out of home ownership in large swaths of California. The dream of building equity and achieving financial stability through real estate is becoming impossible for an entire generation. And the exodus is accelerating. Moving companies report record demand for relocations out of California. U-Haul's data shows a 40% increase in one-way rentals, leaving the state compared to 2022. The destinations are predictable: Texas, Arizona, Nevada, Idaho, states with lower costs of living and functional insurance markets. When middle-class families leave, they take their spending, their tax contributions, and their community involvement with them. What's left behind are empty homes, declining property values, and local economies that are slowly bleeding out. This is not a temporary disruption. This is a structural collapse of a market that took more than a century to build, and once it's gone, it will not come back easily. Let's fast forward 24 months and look at where California is heading if nothing changes. By 2027, analysts predict that as many as 4 million California homes could be uninsured or underinsured. The FAIR Plan, already overwhelmed, will have no capacity to absorb additional policies. Homeowners will be forced to choose between living uninsured or paying premiums that exceed $20,000 per year. Major wildfires will continue to occur. When they do, entire communities will be wiped out with no mechanism for rebuilding. Federal disaster aid will provide temporary relief, but it won't replace lost homes. FEMA grants cap out at $40,000 per household, a fraction of what it costs to rebuild even a modest home. The real estate market in fire-prone areas will collapse completely. Homes that once sold for $500,000 or more will become worthless. Not because of physical deterioration, but because no one can insure them, and therefore no one can buy them. Banks will begin walking away from foreclosed properties in high-risk zones. It makes no financial sense to foreclose on a home that has no market value and can't be insured. Abandoned properties will become the new normal. Entire neighbourhoods will stand empty, slowly decaying as nature reclaims the land. Local governments will face impossible budget crises. Property tax revenue will plummet. Essential services will be cut. Schools will close. Fire stations will be shuttered. The very infrastructure needed to protect communities will disappear precisely when it's needed most. California's population will continue its decline. The middle class, the backbone of any functioning economy, will leave for states where homeownership is still financially viable. What remains will be an increasingly divided society. Wealthy coastal enclaves where the rich can afford $20,000 insurance premiums, and abandoned rural areas where everyone else used to live. This is not speculation. This is the logical endpoint of policies that ignored economic reality in favour of political messaging. California chose to regulate insurance rates without acknowledging the underlying risk. And now, the bill is coming due. State Farm and Allstate didn't abandon California because they wanted to. They left because staying was financial suicide. 2.2 million homeowners are now paying the price for regulatory decisions that pretended risk didn't exist if we just refused to price it accurately. The crisis is accelerating. Every month, more carriers pull out. Every month, more families lose coverage. Every month, the gap between policy intentions and real-world consequences grows wider. If you found this investigation valuable, subscribe to Elizabeth Davis right now. This channel will continue exposing the stories mainstream media won't touch. Hit that like button. Drop a comment below with your experience. Have you lost your home insurance? Are you paying double or triple what you used to? Share this video with every California homeowner you know, because they need to understand what's happening before it's too late. And here's the question we're left with. When the last major insurer leaves California, when property values collapse, when entire communities become uninhabitable, will anyone be held accountable? Or will we just be told this was the inevitable cost of climate change? The answer to that question is being written right now. And so far, no one in Sacramento seems interested in facing reality. The reckoning is here, and it's only just beginning.